talk about tractor maker Escorts Kubota, and that is in focus today. And why? Because the stock has actually scaled up when you look at it right now to life highs, zooming as much as 14% over just 5 days. Let's bring on board Srishti to tell us what is actually helping the industry, what is aiding this rally in terms of for Escorts Kubota. Let's go across.
Well, yes, Escorts is sitting at a life high levels, and look at the move in the past 1 month where Nifty Auto is down by 0.8%. Escorts has shot up by 24%, and that's after its Q1 report card where we have seen the company losing its domestic tractor market share. The profit was actually fueled by the other income, and they've also informed that the Kubota merger has been pushed by another 6 months. But definitely there was a surprise onto the number front, especially on the margins. So let's try and understand what the street investors are penciling in and why the excitement in the stock price. Firstly, talking about their margins coming in at 14%, the company expects it to maintain those levels. They have kept the tractor growth volume guidance intact, where they expect the tractor industry to grow in low mid-single digit in terms of volumes for FY24. Thirdly, the Kubota synergies are still expected to kick in terms of the new product launches as well as the export opportunities. And the fourth impact is the improved prospects for their railway and construction business. And lastly, don't forget that it is going to be an election year, so the demand is expected to be on the higher side. Coming to the railway and construction business, what we see that the contribution has increased substantially from just 6% of contribution from the railway segment in FY17 that has now shot up to 13%, and there has been a significant improvement into their EBIT margin, and the company expects double-digit growth in FY24 as well. Their order book is quite healthy, and when it comes to their construction business, their EBIT margin has improved from a negative figure in FY17 to a 7.6% in positive side in Q1, and they've guided for a high single-digit margin for FY24. FY28 growth outlook, the company expects their revenue to be over 22,000 crores, EBITDA margin to be in mid-single, export contribution to grow over. So all these factors definitely are there. But lastly, having a look at the valuations, can't say that it is cheap because 1 year forward multiple is coming in at 26.2 times or when it comes to the PE, but versus the 5 years average of 16.2. So can't say that it is cheap right now given the move that we have seen in Escorts, but definitely a lot many triggers at play.